All right, so today I wanted to do a video on Broadcom. Again, this is a very large company, a company that's performed absolutely amazing over the last 10 years, like absolutely phenomenal. Again, this is a company that I bought. I was buying it in the 500s and 600s, and then when it went up into the 700s, 800s, I stopped buying, hoping that it would have a pullback, and then I'll start getting back into it. And then went over 1,000, and I'm like, screw it, I'm just going to sell it. I'm up like 100%. Again, at some point there'll be a pullback. Again, there's never been. I mean, there's been pullbacks, but nothing significant. Now we are currently up over 1,200. Again, this stock, I believe, is in the top 10 stocks in the NASDAQ. Again, one of the largest companies in existence. So again, let's get right into it. Again, they are a semiconductor company. Again, everybody knows what that is. Again, free cash flow yield right now of 3%, which again, a little bit lower than I would like to see, but again, not necessarily terrible. Current dividend, 1.72%. Again, when I was buying it was like 3%, which I thought was amazing for a company I was expecting to grow, not this much, but I was still expecting them to grow quite a bit. So again, looking back on it, it was certainly a bad idea to sell. And this is a lesson that I take, and I think a lot of people also need to take too, is that a lot of times when you have these big winners, you don't want to just sell them just because they've ran up a lot, because they can run up a lot more. And if they're still a really good company, you shouldn't sell them. And then that's a lesson that I kind of learned the hard way. But I mean, it wasn't really, you didn't really lose money. You made money, but you could have made a lot more. So again, let's get right into it here. Analysts, fairly bullish. Again, current dividend is 46. The 5-year average is 3.2%, right? So again, I'll get into that a little bit more. Financial health, again, this company's solid, okay, not great. They're growing all right, not phenomenal, but the profitability is where this company really shines, right? Extremely, extremely good there. Management, again, stock-based compensation certainly is a little bit concerning, but return on invested capital, 31% is amazing. Like that's phenomenal. The valuation, again, obviously running up this much. This company is clearly overvalued where it's at right now. But again, I mean, a price to free cash flow of 32, a PE of 40, I don't think that's outrageous by any means. Like, honestly, I don't think it is, because, I mean, I think a price to free cash flow of 15 is too cheap. I think it probably should be 20 to 25, right? That's probably where I would have it, right? Price of sales of 16, again, that's definitely expensive, right? So again, it definitely is expensive where it's at right now. I would be waiting for a pullback, probably 20 to 25% based on current levels of earnings. So again, it would have to go down below 1,000 before I would be looking into it. Let's get right into the financials here. Again, balance sheet, again, solid. It's not great. It's decent, but it's definitely not great. Again, cash flow, there's one area where this company really thrives, and that's the free cash flow growth. Again, look at this growth. It's just absolutely phenomenal, right? They've more than 10x'd their free cash flow growth over the last decade. That is absolutely insane growth. And again, I'm honestly, I'm kind of speechless just for how good the free cash flow growth has been for this company. Just absolutely insanely good. Again, they have been buying back shares for the last 6 years consecutively. And again, it looks like the last couple of years they've bought back even more. Again, they haven't taken on debts in 3 years, which is good to see. Again, so everything checks out good here, very good here, if anything, right? If we look at their metrics here, again, operating cash flow margin, free cash flow margin, again, both of these numbers are absolutely phenomenally good. Like a free cash flow margin of 49% and operating cash flow of 50%. Again, that is crazy good, like crazy good. And those numbers have been almost exactly within a couple of percent for both of them going back 4 years. Right, going back 4 years. So that's another thing that's very good. Again, return on invested capital. It never was that great up until basically a couple, 2-3 years ago. I mean, they've improved that number 4 years in a row. So it's interesting to see how that's going to go. As far as the dividend goes, this is one of the things that really attracted me to them originally. Now I think it's definitely not nearly as appealing, but I think still think it's okay. I mean, the payout ratio based on free cash flow is 55%. They're going at 14.6% per year, which is extremely good. But again, given the payout ratio is 55%, are they going to be able to keep growing at 14% per year? They're going to have to keep growing extremely quickly to maintain that, which I think they can, but there's going to be diminishing returns at some point. So again, another thing to point out here, if you bought this company 10 years ago, you would have a 39% yield on cost. That is absolutely and utterly insane. I mean, even if we just go back 5 years, just out of curiosity, what would that be? Looking at about 7.5%, almost 8%, right? So again, that's still extremely good. And that's just 5 years. Like, that is literally just 5 years, not that long of a time. Again, the last thing we'll get into here, free cash flow, or the valuations over time. Again, just a consistent lineup, which is very good to see. If you look at its historical valuation, though, I mean, it traded even more expensive than it is now. Back in like 2016 for a good period of time, 2015, even late 2014, it was more expensive than it is right now. I mean, if you bought it, like, looks like basically the cheapest it got was in 2020, but then also late 2022, back in October. Like, that was I think that actually was when I was buying it. I would have to look back and see, but I think that was when I started. So again, that was an absolute steal of a deal if you bought it there and you're still holding. Again, if we look at the operating cash flow per share, they've grown that again 31 and 35% per year going back 10 years. Again, the premium that people are paying for it has also barely gone up. Like, it's not gone up that significantly. Again, the average price of free cash flow over that period of time was 24.6. So again, almost exactly where I had it, 20 to 25. I think that is clearly fair value. Again, currently at 37. Again, just too expensive. Let's go back 5 years just to see what changes here. So again, go back 5 years. Again, they haven't grown nearly as much. But the one thing that is concerning here is the premium that people are paying has grown a lot faster. So that's something that's extremely concerning, is people are simply paying more for no more earnings, for no more actual bottom line growth. And again, that's something that's very concerning. Again, over the last 5 years, the average price of free cash flow has been 18.7, right? So that's something that's certainly important to point out, that it's clearly way too expensive right now. Like, it's way too expensive. You'd have to, like I say, 20-25% drop before I would be interested. I certainly would be interested at some point, but I don't know if we're going to get that barring a big crash. So anyway, that is Broadcom stock. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.